Welcome to Nature Backed. Today my guest is Jessica from Planet A Ventures. Hi.
Hey, thanks so much for having me. Yeah, as you said, I'm Jess. You can call me from London originally, now in Berlin, working at Planet A. We're a European venture capital fund pioneering a science-based approach to impact investment.
The Planet A, how did you guys get the name? I mean, I think there is a Plan A or is it the Plan B and there is a Project A VC firm also. I was slightly confused.
Yeah, exactly. We have a few competitors for the name, but it came from the idea that there is no Planet B, so we better protect the one we have.
Kind of logical. What's the background? I mean, science-based fund, have you been around for long? I don't know, how much have you raised or what are the kind of the biggest milestones on the road so far?
Yeah, we raised 160 million first fund. Back in, I think it started 2021 is when we officially closed.
And so far, any major success stories to, write or tell to the parents at the Christmas table?
It's still early days. VCs have very long timelines, unfortunately, but we have had a few positive signs, let's say, from some of our portfolios raising now successful B rounds and big A's and the likes.
Mm. You said science-based. How do you actually, take that science into the assessment? Can you walk us through a little bit of how it becomes scientifically backed?
Sure. So yeah, Planet A, we're born from the conviction that scientific integrity is foundational to startup scalability and environmental impact. So we thought about how to make that structurally a reality rather than just some marketing tagline. And so from day one, we built an in-house science team who has a veto power over our deals. So if the science behind the startup's claims of emissions reductions doesn't hold up, then we won't invest. And what that looks like is a quantification, typically in the form of a systemic lifecycle assessment. So that's measuring all the emissions, biodiversity impact, waste, resource use, and more over a product's entire life cycle. Which is also in a way a value add to the founders as it helps them build credibility and can be a value add in sales, in hiring and fundraising and more.
Mm. And every now and then I also run into the investors who start to ask about what is the impact measurements you guys are using in your early stage company and how this all comes across to the customer side and so on. So that seems to be increasingly common in the industry.
Yeah, absolutely. We're getting there.
I think Planet A was originally seen as a CEO kind of climate investment firm or that maybe climate first. Maybe it's just external, but you're kind of moving quite a lot beyond just the climate, resource savings, waste reduction, biodiversity. Why is that? Why are these new kind of planetary boundaries on the map?
Yeah, it's a great question. I think it gets to the heart of how we think about climate impact and environmental impact. Carbon reduction is essential, but it is only one piece of the puzzle. So we see this crisis as multiple interconnected planetary crises. So that's a sort of planetary boundaries framework that we work with that has these 9 boundaries, including climate, obviously, but also biodiversity, nitrogen cycles, land use, and a few others. And these essentially define the safe operating space within which we can live as humanity. Fortunately, we've now transgressed 7 out of 9 of those. So we're really pushing the limits of what this Earth can handle. And that's why focusing just on carbon doesn't quite cut it if you want to prevent total ecological collapse.
What gives, as an investor, what gives the kind of positive mindset or, as you said, 7 out of 9 are broken already. Isn't it kind of, most investors probably, put their money in gold and try to, survive somehow the imminent apocalypse.
You have to be an optimist in venture capital if you want to continue. And you also get the privilege of talking to brilliant people and teams who are working on real cutting edge solutions. So you get infused with that optimism through the work you do, as well as needing it to keep going on.
That's a good point. But those startups you talk to on a regular basis are coming from all kind of sides of life, so to say. Basically, you might be comparing the potential of two totally, completely different companies. For example, a green logistics startup versus a sustainable materials deep tech company. Is there some kind of the central KPI you're looking at those when you look at those companies?
Yeah, that's one of the more complex questions in impact measurement when you do take a broader perspective. So we do have comparable units across all our investments. Each company sets their own KPI to make it sure that it's in line with their business objectives. And then we have several different comparable units, so tons of greenhouse gas emissions, meter cubed of resource or water resource. So our impact formula is the same across all of them, and it's always that the impact is equal to the improvement coefficient times or multiplied by the business forecast. So the improvement coefficient is essentially that functional unit of improvement for the startup. So, for example, for our company Traceless, it would be ton of bio-based material produced. For a heat pump installer, it could be number of heat pumps installed. And then the business forecast indicates how fast they can scale. So how many of these units they can put into the world. It gets harder when we look at, because we also invest in enabling technologies, which don't have any direct impact. So for example, MakerSite is a supply chain company improving on average carbon emissions by suggesting lower carbon alternatives, but they cannot directly say that they reduced them. So there it gets a little harder to have these comparable units, but we use individual proxies. And we co-develop these with the founders so that it's not just sort of for our LPs, but rather for them and how they understand their impact and measure it.
Coming back a little bit to this science team having the final veto power, how often does it actually happen? Is it more of the marketing slogan, or do they actually come back and say that, sorry guys, this makes no sense from the climate perspective?
Yeah, so the impact team or science team is working hand in hand with the investment teams through the process. It's not something that they kind of wait until we get to the final.
All the work is done.
All the work is done. They have told us many times that we can't do certain investments, but we typically find that out earlier than at the point we get to needing a veto.
Yes.
Yeah. So we've had many things that we couldn't invest in, but there were not vetoed as such, but we know that there would be a veto if we continue to push them, so we don't go that far.
Going a little bit to the hardware side, you co-authored a climate hardware playbook. The hardware is famously tough for the VC funds due to the longer timeframes, or at least assumption of the longer timeframes and the capex needs. What are the specific signals or evidence you guys look at for in a climate hardware startup that might be de-risk the investment for you guys?
Yeah, you're totally right. Dealing with atoms, not bits, as it's called, is always harder. It is more complex, longer timelines, higher capex. That said, there's quite some data indicating that deep tech, which is predominantly hardware, outperforms software in the longer run. So it's a really exciting space, but we do have to, as you said, look for specific signals. So the first, I'd say, what's the most important is cost parity as the North Star. We had one of the major learnings, at least, is that environmental impact is not enough. I think that's ever more present, but it's always been clear. We look for the underlying physics push towards a more efficient, lower cost of ownership technology than what the incumbent in the market is. That's where like cost down engineering, modularization, and smart capex can be really important as well to enable that. And then the second is more to do with the team. So we really look for commercial literacy in the team. I think it's a surprisingly common issue that these scientific related companies lack commercial go-to-market expertise often. You can complement it with a strong advisory board and keenness to learn, but you cannot skip on the commercial side. You need to have someone who can really get the customer insights, make commercial hires, fundraise, and navigate offtake structuring and the rest of it. And then on top of that, I think capital planning is key. So I think a lot of first-of-a-kind plants fail not just because of the technology, but because of poor planning and also EPC misalignment. We need to see founders who understand that they need to have a staged roadmap. They need to have a realistic roadmap and understand that EPC's incentives are misaligned to theirs and they cannot just rely on them to do it all for them. And thinking how to simplify the design, not over-engineering it, but how to make it more modular. And then beyond that, also, we really look for commercial signals. So we don't typically see revenue until Series B with real hardware, deep tech innovations, but we can see indications like letters of intent, offtake agreements, and clear buyer intent. So we usually do our own customer calls and check that as well.
Mm. It was really interesting comment you made probably early in this long answer about the cost parity. Because being in the hardware startup myself, I see that challenge on a regular basis. How maybe the new technology, which on OPEX level becomes cheaper over the years, the first CapEx shock of the more expensive, the kind of new green option is still quite a hurdle for the actual buyers to overcome.
Mm-hmm. Yeah, I think particularly you're referring to sort of technologies that are fairly mature, like electrification, where the total cost of ownership is reduced, but the upfront cost is higher because the cost curves have not come down yet. Yeah, I see that everywhere as well. I think that's actually one of the key levers for innovation. A lot of these technologies we need, especially in energy, are attractive. In the longer term, policy support exists and they're only going to get cheaper and more efficient due to the increased scale. But tens of thousands of these projects for electrification are stalling due to the financing friction. So I think we need better underwriting, better capital that can flow fast to these areas. And I think the best way to address that is via improved underwriting so that you can assess these projects at scale and lend to them. And I think that AI and data infrastructure is a big unlock there as well, as they can read the project, validate its technical performance, and make those risk assessments in more real time, allowing capital to flow there faster.
The other interesting comment you said was about the focus also on the kind of commercial capability of the early teams, because I've also been in founding a startup where we were just two commercial guys and we were just looking for the technological guy to help for it. But we were still, got to a certain extent without any technological know-how. So it's quite an interesting balance in general in early stage startups where you kind of need both sides. Even if it's a science project which has been, growing out of the lab in 5 years, but still somebody actually needs to sell it to somebody. And often I see also that the founders are not really, they don't fully understand the size of the challenge they might face.
Totally. I think that's one of the most misunderstood, one of the most misunderstood needs of these early stage science companies. They're often waiting until everything is perfect to go talk to customers. I think a lot of technical founders, it's rooted in scientific training, and these people are often perfectionists and they wait too long to engage with the market, and then they often end up creating things that are over-engineered or not really what the market is wanting can be very dangerous if you don't get that early feedback and integrate it into your product development. So yeah, I think making sure you get that outside world in early is critical.
One of the new things on your work table is that green manufacturing software. Tell us a little bit, what is it exactly and why is it on your table? What fascinates you in this?
Yeah, I think it's a huge an underestimated bottleneck in manufacturing and enabling green manufacturing is the disconnect between what we theoretically can gain in efficiency and what's happening on the messy factory floor and real-time decision-making. So across sectors and industry, I mean, in a broad sense, is one of the largest emitters that we have. Cement and steel are the well-known ones, but across the board, automotive, all kinds of infrastructure are super highly emitted. So when we reduce emissions there, we have also quite immediate effects and really exciting in terms of impact. But the barrier isn't just sort of physically not knowing how to, but it's about actually having those system level changes. So I think, yeah, this efficiency gap often comes from the data, which is sitting in siloed and poorly contextualized and poorly integrated systems. And so you might have a machine, for example, that could run 20% more efficiently and save you a huge amount of cost there because energy might be quite a high cost for you. But no one is empowered to make that tweak and change that parameter. And I think, so maybe to draw light on one key example in my mind, which is more apparent to me because we're invested in them, Carbonary bridges that gap in that they offer this AI solution to assist in hard to abate industries to save them energy and money and carbon, of course. So their first software is focused on the cement industry and leverages unused data, creates a digital twin that's tailored to each cement plant. And then the AI software produces this live, very specific, quantified recommendation of how the people on the ground, the plant operators, can increase the efficiency in their manufacturing, and that results in massive cost savings for them.
I think at least one kind of cement AI company has been on the show here also a couple of years ago, but I just can't remember anymore any longer what was the exact name of it. I'll add it later to the show notes for the listeners and the viewers to check out, because that's a really fascinating field and the huge possibilities there in the kind of cement industry for startups. I would have not thought about saying this a couple of years ago, but it has somehow become really a big topic. The energy transition, you kind of touched up on a little bit, but in the where do you see the kind of the energy transition bottleneck today? What's the most exciting hidden deep tech opportunity in the energy field? Is it in the grid? Is it in the smart heaters? You mentioned the company installing the heating systems, the heat pumps, or is it some kind of industrial decarbonization game?
Yeah, like I mentioned, I think financing is going to be a massive unlock because in energy, there's been quite a few studies. We have enough technology that we could cost effectively decarbonize today, but we don't have enough of the financing for it or push for it. So I think, yeah, and 70% is still fossil fueled, which is so much work to be done. So I think sort of that enablement factor and also AI can help us speed up processes to get it in the ground is going to be key. Another one that I'm pretty excited by is the potential for industrial heat, which is increasingly becoming cost effective to electrify, especially low temperature process heat. And that's also a cost saver. So that's pretty exciting. For the high temperature, there's still a lot of innovation going on, and I think it's getting there. But still, I think potential for us to improve at least on cost.
Absolutely. Your background is in climate policy. How does that help or impact your investment decisions today, or what are the benefits from that?
Yeah. So, slight disclaimer: it's a short amount of time I spent in climate policy at the beginning of my career, but it definitely gave me respect for the role that regulation can play in shaping markets. And I think now the paradigm has changed a lot since I was also working in policy. So, first of all, policy, I think, is really important for us to understand, in that it's shaping the markets. We have to, as an investor, look very forward ahead and see what's coming on the horizon. That said, we don't invest in things that are dependent on subsidies or single policies. We don't look at policies and then make an investment based on it. We have to find, as I said, cost parity with the investments we make or improvements. So where there's real customer value and the unit economics make sense outside of a subsidy or policy. But we have to stay attuned to how the world is changing. And I think fundamentally we're moving into a more fragmented world right now. We can see it with the tariffs, the recent critical minerals, rare earths act, EU facing pressure and political pressures around net zero. And we're sort of moving into a more multipolar world, which I think is going to really fundamentally shape how the tech industry also works, and every industry within the world.
Absolutely.
So yeah, we try and play that out into how it's going to affect startups that we look at, and support our founders also in diversifying sourcing, building more resilient manufacturing footprints, and having those contingency plans for disruption if it happens.
I'm sure there is already AI tariff startups who solve the problems for the companies shipping their stuff across the borders to the US or out of the US.
Yeah, I think a lot of supply chain startups integrate that as a sort of module or feature for sure.
Yeah. The last one before we go, if you could mandate one non-financial metric, something related maybe to nature or ecosystem or resources, to be tracked by every tech startup, what would it be and why?
It's a hard question. I think I couldn't boil it down to one thing.
You have a list ready?
I have a list, yeah. I think ecosystems are just highly complex and interconnected. So I think focus on one metric can sometimes be a little misleading. I'd maybe just mandate that they have a mindset and framework to look broadly at the environmental impacts of their model and see what it means across land use, water footprint, biodiversity, disruption, resource intensity, and ask what are the most material environmental impacts of our model. And I think every company should have a science-based informed view of its environmental dependencies and impacts, and hopefully commit to improving them over time.
Thank you. That's a very good point to wrap up this discussion. Thanks, Jess, for joining us.
Thank you so much, Tomo.
If you like the show, subscribe and leave a good rating on the podcast platform of your choice. It would mean a world to us.
Hi, I'm Lessa Gadet, host of Her Extraordinary Life by Design podcast, where we celebrate women who are shaping their lives one extraordinary day at a time. I speak with women from all over the world about what they do and how they are passionately pursuing their dreams and creating meaningful impacts on their communities. So come join us and learn about all there is to learn about these extraordinary women.
Electricast. There's a change happening in the way we live, the way we work, the way we spend our money and make our decisions. We are evolving to be more conscious in our actions in a way that serves the world and makes it a better place. Welcome to the Ethical Evolution. The mission is simple: to spread stories of collective change that make the world a better place, understanding that to create collective change, We need to be the change. It all begins with us.